I think that valuations are pretty full on in the U.S. Certainly, it's been a place we've seen global investors very focused in the last few years. With the latest payrolls number, things look pretty good for a recovery continuing in the U.S. You have low unemployment. You do have the questions of what's going on around the election, but at the end of the day, certainly the business environment looks very constructive in the U.S., but earnings is being watched. Yeah. I would say what's been very interesting for us with clients with U.S. equities, despite the valuations, with what has happened post-Brexit, people have put some European investments on hold and continued to focus on their U.S. investments. I think that's starting to shift, but in general, there's a fair bit of confidence in the U.S. recovery, so it's about finding your spots where valuation is still reasonable.
Okay, need to look for a sweet spot. In terms of the recovery, you know, there are people out there, including, say, Deutsche Bank, right? And they're calling a 60% chance of the U.S. economy tipping into recession. Is GS in that camp at all? Or?
I don't think we remain quite that worried, no. Certainly there are some factors to watch, right? But I'd say they're more about what is the global scenario for growth, and is there some exogenous shock that makes you worry about U.S. growth? Certainly, I don't think Brexit was helpful. And from the perspective of, again, any trend that goes counter to globalization, that's an issue. The U.S. dollar is also a major issue. From an export perspective, certainly it makes things much more difficult. That said, the recovery seems relatively stable. So to us, we look at a continuing, ongoing, not crazy good, but good recovery. And I think we look to the Fed and say there are a lot of countermanding trends as they decide whether to hike rates by the end of the year. Okay. Post-Brexit, as things calm down, you know, it went to about a 25% odds. I think today we look at it and we look to the fourth quarter and say it's possible.
Possible December?
Possible. Possible. Wow. If you kept seeing payroll numbers like we've seen, if some of the global issues that have caused instability calm down, and there is strength, greater strength maybe than people expect in the recovery, that's a risk. That said, you know, in an election year, anything goes, and it is tough to take action in the fall.
Indeed, who knows, right? You know, this disconnect between the equity market and the bond market, exacerbated, of course, by safety flows post-Brexit. But if GS is thinking maybe December for a second rate hike, what does that mean in terms of U.S. yields? You know, it wasn't that long ago we were at record lows in the low 130s or so. What happens now?
Look, I think it's a real challenge. You know, one of the biggest issues, again, in the search for yield is looking at the various places clients have gone within the U.S. markets. High yield is a great example, right? And so, again, you've had investors come in and out of this market. I think you look at the scenario today, post the issues that we've had in the energy space, which was the big latest challenge to the high yield market over the last year or so, where you saw quite a bit of deterioration in credit quality because over 15% of that marketplace was related to the energy sector and its growth in the U.S. You get to today and you look at the high yield market, and with the Fed, you know, unclear in its actions and the recovery unclear, it's a very challenging space. We have clients putting both money in and out. That's how confusing it is.